All right, let's dive into something that's absolutely critical for any fiduciary: how to handle expense allocations when a trust has both taxable and tax-exempt income. Getting this wrong is one of the fastest ways to attract an audit. So, we're going to break down exactly how to build a defensible, audit-proof return.
So here's our game plan. We'll start with the foundational rule, IRC Section 265. Then we'll get into the real nuts and bolts, sorting your expenses, doing the core calculation, and tackling the whole issue of unbundling fees. After that, we'll cover how to get it all down on Form 1041 correctly, and we'll wrap up with the protocol you can use to stay out of trouble.
Okay, first things first, we have to start with the bedrock of this entire process: Internal Revenue Code Section 265. Everything else we talk about today is built on this one section of the law. It's a fair question, right? Why can't a trust just write off all its admin costs? Well, the answer gets to a really fundamental principle of our tax system. You see, if the government isn't taxing the income, it's not going to let you deduct the costs of making that income. Simple as that.
And this is the principle in black and white. It's called the no double benefit rule, and it's written right into Section 265. The logic is, well, pretty straightforward. You can't have your cake and eat it too. You can't enjoy tax-free income on one hand and then ask for a tax deduction for the costs of earning it on the other. It just doesn't work that way. Now, what's interesting is that Section 265 actually splits this into two parts. The first part, 265A1, covers general stuff like fiduciary fees and legal costs. For those, you do an allocation. But the second part, 265A2, is way more strict. It's all about interest. If a trust takes out a loan specifically to buy or hold tax-exempt bonds, the interest on that loan is 100% non-deductible. No allocation, no proration, just a flat-out, nope, you can't deduct that.
So, with that foundational rule locked in, our first real practical step is to start sorting every single expense that comes through the door. And this isn't just a good idea. The Treasury Regulations actually require it.
Yep, Treasury Regulation 1.652b-3 forces you to put your expenses into two buckets. The first bucket, direct expenses, is the easy one. A repair bill for a rental property that goes 100% against the rental income. But the second bucket, indirect expenses, things like the trustee's own commission, that's where things get complicated. And honestly, that's where most of the audit risk is hiding. And that brings us to the absolute heart of the matter. How exactly do we allocate those indirect expenses? The IRS says you need a reasonable method. But what's reasonable? As you're about to see, the choice you make here can literally change the tax bill by tens of thousands of dollars. Okay, so you've basically got two major plays here, both established by landmark court cases. The default method, the one the IRS usually expects for things like annual fees, is the gross income method. But then there's the Fabens case, which gave us the market value method. And this one is absolutely critical for special situations, like when a trust is terminating, and the fees are based on the total value of the assets, not just 1 year's income.
Let's zoom in on that Fabens formula, because the magic here is all in the denominator. Look at it. It's not just the income. It includes realized capital gains, and this is the key, the unrealized appreciation of the assets. When you think about it, that makes perfect sense, right? A termination fee is based on the total value you managed, so the allocation formula should reflect that total value too.
And the stakes? They're huge. In the example from the source material we reviewed, picking the right formula, the legally correct formula, made a $30,000 difference in the amount of deductible expenses. That's a massive swing. We're not talking about rounding errors here. Now, on top of the court cases, there are a couple of IRS revenue rulings you just have to know. First, Ruling 77-355 says that for the gross income method, you have to exclude capital gains that are part of the principal. But then Ruling 8165 gives you a little bit of a break. It says you have to use gross income in the denominator, so gross rents, not net rents. That actually makes the denominator bigger, which lowers the allocation percentage and reduces the amount of fees that get disallowed. Okay, so just when you think you have the allocation figured out, there's another layer to this onion. Before you can even start that Section 265 calculation, you have to take a step back and look at the nature of the fees themselves, thanks to the rules in Section 67E. And it all comes down to this, the Hypothetical Individual Test. You have to ask yourself one simple question. Would a regular person holding these same assets have incurred this cost? If the answer is yes, then that cost is not fully deductible by the trust. To be fully deductible, it has to be a cost that is unique to running a trust or an estate.
Let's make this really concrete. Things like probate court fees or the premium for a fiduciary bond. An individual would never pay those, so they're unique to the trust and fully deductible. But what about investment advisory fees? Well, any individual investor might pay those, so they are not unique and therefore not fully deductible. In this quote from the regulations, it is everything. The IRS does not care what you call a fee on the invoice. You can't hide an investment advisory fee by calling it a general admin fee. They're going to look at the actual service that was provided to decide how it should be treated. So what's the bottom line? If you, as a fiduciary, charge a single, bundled fee that covers everything, you have a legal duty to unbundle it. You have to break it apart into its different pieces, the fully deductible parts for trust administration, and the not-so-deductible parts for investment advice. And get this, you have to do this before you even start the Section 265 allocation we were just talking about. All right, we have done all the hard work, we've sorted, we've unbundled, we've calculated. Now, how do we actually put this on the tax return, Form 1041, without setting off alarm bells at the IRS? Well, the IRS couldn't be more clear about this. The instructions for the 1041 say it right there. The numbers you put on the main form, those are the final post-allocation deductible amounts. All the messy calculations, that does not go on the return itself. So here's exactly where it all goes. The final numbers land on lines 12, 14, and 15 of the 1041. But, and this is crucial, if the trust has tax-exempt income, you're going to check yes to question 1 in the Other Information section. That checkmark is what tells the IRS you're attaching a separate sheet that shows all your work, the gross numbers, the formula, and how you got to the final answer. That attachment is your audit shield. Okay, let's pull all of these threads together. Let's synthesize this into a clear, step-by-step playbook you can use for an audit-proof return every single time. Here it is, 5 steps in order. 1. Classify your receipts. 2. Segregate your expenses into direct and indirect. 3. Unbundle those fees using the 67E test. Step 4 is when you finally select and apply the right allocation formula. And step 5, you document everything meticulously, putting the final numbers on the 1041 and showing all your work on an attachment. Following this sequence creates a clear, logical, and defensible trail. So I'll leave you with the question on the screen. Take a hard look at your current process. Is it truly reasonable if an auditor came knocking? Because at the end of the day, audit proofing isn't about finding clever loopholes. It's about having a rigorous, defensible process. Meticulous documentation and a correct application of these rules, that's not just about compliance, that's the very definition of professional diligence.